Have you ever really, stopped to think about what money is? I mean, not just the coins or the numbers on your screen, but what actually gives it value? How do we even get here? And what makes some money good and, well, other money not so good?
It's a huge question, isn't it? We use it constantly, every single day.
Mhm.
But yeah, we rarely dig into, the history, the principles behind it, or why sometimes it just fails.
Exactly. And that's really our mission for you today. We're doing a deep dive into Saifedean Ammous' book, The Bitcoin Standard, the decentralized alternative to central banking. And it's not just about Bitcoin, really. It's this massive journey through the whole story of money, from ancient stuff right up to the government money we use now. And then Ammous brings in Bitcoin as this completely different decentralized option for the future.
Yeah, our goal for you is to unpack these core ideas Amos talks about, like sound money. What does that even mean? And why does he argue Bitcoin might be its ultimate form? We'll look at what that implies for, the economy, innovation, even things like individual freedom, and we'll get into some really interesting historical examples too, some surprising ones.
And the author, Saifedean Ammous,
hmm
is a well-known economist, right? Known for writing about crypto and economics. He wrote the Fiat Standard too and Principles of Economics. Got his background from Columbia and the London School of Economics. So he's got some serious credentials here.
Definitely. So, okay, to really get Amos's view, we need to start at the beginning. What's the basic problem money solves? Why do we even need it? He kicks things off by talking about barter. And the big problem there is the coincidence of wants.
Ah, yeah, the classic problem. Like, say you make amazing baskets, really top-notch, and you need vegetables. But the farmer, well, maybe he just doesn't need a basket today or ever. You're stuck.
Exactly. It works sort of in tiny groups. But try scaling that up. Forget it. Think about it. How do you price everything? What if your goods spoil? Or just finding someone miles away who wants your specific thing and has the specific thing you want, it's a mess.
So money just pops up as this brilliant workaround. It's
Yeah.
basically a good that everyone agrees to accept, making trade indirect. It just simplifies everything.
And it does three main jobs. First, it's a medium of exchange. No more direct swapping needed. Sell the basket for money, buy the veggies. Simple. Second, it's a store of value. You can save your wealth. But crucially, that means the money itself has to, hold its value over time.
Okay, medium of exchange, store value. And the third.
The third is unit of account. It gives us a common yardstick for prices. Instead of pricing in chickens or baskets, you just use dollars or gold coins, whatever. Makes math way easier.
Okay, so those are the functions.
Right.
But what makes money good at those jobs? Ammous talks about saleability, right? What does that mean exactly?
Yeah, saleability is huge in his framework. It's not just can I spend it? It's
Yeah.
about how easily it sells across different dimensions, across scale, so it needs to be divisible into smaller bits, across space, meaning you can actually move it around easily, portable, and maybe most importantly, across time. Does it hold its value tomorrow, next year, decades from now? That's key for storing wealth.
Right, saleability across time. That sounds like the big one for building wealth. So how does he measure that? How do you quantify this idea of money being hard? Is it scarcity? He brings in this concept, the stock-to-flow ratio, doesn't he?
That's it. The stock-to-flow ratio, it sounds technical, but it's pretty simple. It's just the ratio of the existing supply, the stock, to the new amount being produced, the flow. A high ratio means it's hard to make much more relative to what's already there. That indicates hardness. It means the supply isn't easily inflated, so it holds value better, even if demand jumps around. And this helps explain what he calls the easy money trap.
Yeah, he has this quote. It's pretty blunt. A money that is easy to produce is no money at all. And easy money does not make a society richer. On the contrary, it makes it poorer by placing all its hard-earned wealth for sale in exchange for something easy to produce.
Pow. It really contrasts easy money, think stuff, where you can just crank out more, leading to inflation with hard money. Hard money is tough to produce, so it tends to keep its value better. Understanding this difference and how technology impacts it is really central to his whole argument.
Okay, so let's get into those historical examples. He talks about primitive monies, which are often kind of cautionary tales, like the rice stones on the island of Yap, those giant stone discs.
Oh yeah, the rice stones are fascinating. Huge, heavy limestone wheels. Their value wasn't just the stone itself, it was the incredible effort involved. Quarrying them on distant islands, hauling them back on canoes across dangerous seas. It literally represented blood, sweat, and tears. The difficulty was the value.
But then this American guy, David O'Keefe, shows up in 1871, shipwrecked, sees the stones, and gets an idea. He uses modern tools, a ship.
Yeah.
It basically makes quarrying and transporting them way easier. What happened?
Well, the locals, they actually rejected O'Keefe's stones. They knew the value wasn't just the object, but the difficulty of getting it. O'Keefe, by making production easy, totally tanked the stock-to-flow ratio. He basically hyperinflated their money.
Wow. So the ease of production destroyed their monetary role.
Mm.
Ammous says, the story of O'Keefe is highly symbolic. The encroachment of modern industrial civilization on Yap. It really illustrates the point.
And you see similar patterns elsewhere. Agri beads in West Africa. They were valuable because they were scarce, hard to make. Then European colonizers figured out how to mass produce them, flooded the market, their value collapsed, which hurt the local economy badly. They even got called slave beads.
It's kind of brutal. And it wasn't just stones and beads, right? Things like seashells, cattle, even salt were used as money. But they all eventually failed as money when production got easier or something better like metal coins came along.
Yeah, the lesson Ammous draws is pretty stark. Technology can wipe out wealth if the money isn't hard. He says, the underlying dynamic of a drop in stock-to-flow ratio has been the same for every form of money that has lost its monetary role.
That's a really powerful point. It suggests this constant vulnerability. Makes you wonder, so if primitive monies were so fragile, what came next?
That brings us to metals, right?
Yeah.
Gold and silver.
Exactly. Metals became dominant because they just had better properties. They're dense, durable, easy to measure, hard to fake compared to shells or beads, much better for trade, easier to transport. They don't rot like cattle.
And between gold and silver, Ammous argues gold was the clear winner. Why gold specifically?
Gold has some pretty unique chemistry going for it. First, it's incredibly stable. It doesn't rust or corrode. Almost all the gold ever mined is still around. Second, and this is critical, you can't just make more gold. You can't synthesize it. It's chemically inert and very rare. These things made it super reliable as a store of value. The book calls it the only final extinguisher of debt. And that stability led to the gold standard. The book really emphasizes how that era, the 19th century, saw this huge boom in global trade and wealth creation. La Belle Époque, they called it.
It really did provide a stable foundation. Predictable money makes long-term planning and international trade much easier. But, even gold wasn't perfect. New gold discoveries could still cause inflation, though relatively minor compared to other things. And then there's the big one, debasement. Rulers figuring out they could cheat.
Right, debasement. Clipping coins, mixing in cheaper metals. We saw that with the Roman Empire, didn't we? The book links their decline partly to emperors constantly messing with the currency, caused chaos.
Whereas the Byzantine Empire, for a long time, had much sounder money and arguably lasted longer partly because of it. It's a telling contrast.
Okay, so this naturally leads us into the modern era, the age of government money or fiat money. Ammous argues this really took off after World War I, a big shift away from market-based money like gold.
And it's not like fiat was a totally new idea. He points to examples like the Chinese jiaozi and K currencies way back in the 10th, 13th centuries. Those were early paper monies that ultimately failed. Why? Government couldn't resist printing too much, led to hyperinflation, suffering. Same old story, really. Echoes of Rome.
And war seems to be a major catalyst here. You mentioned World War I. How did that accelerate the move away from gold?
Well, war is incredibly expensive. Governments needed way more money than they could realistically get through taxes, so they suspended gold convertibility, fired up the printing presses, basically. Inflationary policies became the norm to fund the war effort. The link to gold was broken.
And then after World War II, we had the Bretton Woods Agreement that kind of cemented the dollar linked to gold, sort of.
Yeah.
And the British pound as top dogs, right?
Yeah.
But it didn't last.
No, it propped up the system for a while, but the underlying inflationary pressures were still there. Eventually, in 1971, President Nixon officially ended the U.S. dollar's convertibility to gold. That was the final nail in the coffin for that system. We entered the pure fiat era globally.
And the book's take is that this has major consequences. He says, unsound money makes government power potentially unlimited. That sounds pretty serious.
It's a core argument. If the government can create money out of thin air, it fundamentally changes the relationship between the state and the individual. This ties into the critique of central planning, drawing on economists like Mises from the Austrian school. They argue central planners just can't allocate resources efficiently because they don't have real price signals from a free market, especially a free market in money.
Okay, so there's this critique of central planning. How does this contrast with, say, Keynesian economics?
Right. So the book contrasts the Keynesian idea that government spending can stimulate demand and fix economies with the Austrian view. Ammous argues the Keynesian approach gets causality wrong. It often just leads to inflation, maybe even stagflation like in the 70s, without fixing the underlying problems. The Austrian perspective is much more hands-off. Money should emerge from the market, government shouldn't intervene or control it.
So according to Ammous, what are the tangible results of decades of this unsound government-controlled money?
He points to several things. Central banks manipulating interest rates, for example. He argues this distorts the whole capital market. It leads to malinvestment funding projects that only look viable because money is artificially cheap. And it props up zombie companies, firms that aren't really productive but survive on cheap debt. Plus, he argues, unsound money creates moral hazard, making things like fraudulent banking practices more likely.
Okay, distorted markets, zombie companies. This sounds pretty bleak. But the book connects this back to us as individuals through another really interesting concept, time preference. What's that about?
Time preference is basically how much you value something now versus getting it later. We all naturally prefer stuff sooner rather than later. That's positive time preference. Immediate gratification feels good. But the degree of that preference, how strongly we prefer the present, can change. And Ammous argues money plays a huge role.
Right, so how does sound money affect our time preference? He makes a pretty direct link there.
The argument is that sound money, because it holds its value over time, encourages us to lower our time preference. It makes saving and investing for the future more attractive because you trust the money will still be valuable later. He uses the simple Harry and Linda example. They both catch fish. Harry eats his fish right away. High time preference. Linda eats fewer fish initially and spends time building a fishing rod. Lower time preference, investing for the future. Guess who ends up way more prosperous in the long run? Linda, obviously. Her investment pays off hugely.
And that scales up to whole societies, right?
Yeah.
Lower time preference leads to more savings, more investment, more capital accumulation, basically building civilization. He says, the lowering of the time preference is what initiates the process of human civilization. That's a big claim.
It is. He even links periods of sound money like the Renaissance to flourishing arts and innovation. People felt secure investing in long-term projects.
So conversely, unsound money does the opposite. It makes us more focused on the present.
That's the argument. If money is constantly losing value due to inflation, why save? Spend it now before it's worth less. This discourages saving, discourages long-term investment. It raises society's overall time preference. He also suggests this affects the type of innovation we see. Sound money eras saw more 0-to-1 breakthroughs, truly fundamental inventions. Unsound money eras, he argues, tend to see more one-to-many innovations, just incremental improvements on existing stuff, less focus on the long game.
It's a really thought-provoking connection. Money affecting our psychology, our planning horizon. But is it all about the money? Does he acknowledge other factors? Or are there criticisms of this view? Like, I know David Graeber had very different ideas about debt and money's origins.
That's fair. The book definitely focuses heavily on the monetary explanation. Ammous does briefly nod to the idea that critics might say he's oversimplifying, that many factors shape society. And yeah, people like Graeber in Debt. The first 5,000 years offer very different perspectives, focusing more on social relations, credit, and power dynamics, not just the soundness of the monetary good itself. So the Bitcoin standard presents a strong, specific viewpoint, but it's worth knowing other complex arguments exist out there.
Okay, so if government fiat money has these potential downsides, inflation, high time preference, distorted markets, what's the alternative? Ammous proposes. This is where Bitcoin comes in, finally.
Right. Bitcoin is presented as something radically new, the newest technology to serve the function of money. He sees it as a digital solution to that age-old problem, how to move value across time and space reliably. It's core innovation. It's the first truly scarce digital currency. And crucially, it lets you send value online without needing a trusted third party like a bank.
Okay, no third party. How does it actually pull that off? How do you trust it without a central authority?
It's all about decentralized verification. Instead of one bank keeping the ledger, everyone basically has a copy. It uses clever cryptography. Things like hashing, creating unique digital fingerprints for transaction blocks. And digital signatures prove ownership. The whole thing is secured by something called proof of work. It's this massive computational puzzle-solving contest. The key is that trust isn't based on reputation or authority. It's built right into the system through math and verifiable computation, mechanical verification.
Okay, proof of work, that's the mining part that uses a lot of energy, right? Some people call it wasteful. How does Ammous frame that?
He pushes back hard on the wasteful idea. He argues that energy is the cost of creating digital scarcity and security that you can absolutely trust. That computation, that electricity usage, is what makes it incredibly expensive and difficult for anyone to cheat the system, change past transactions, or create fake bitcoins. It converts electricity into, as he puts it, truthful records. It's the security budget.
And the network itself is described as anti-fragile. What does that mean?
Anti-fragile means it doesn't just resist shocks or attacks, it actually gets stronger from them. Every time Bitcoin survives a challenge or developers patch a vulnerability, the network learns and improves. It evolves. And then there's immutability. The core rules, set way back in version 0.1, are basically locked in. Changing fundamental things like the supply limit would require near impossible levels of consensus. It's designed to be stable.
It's had quite a journey, from basically zero value initially.
Yeah, to the first trades for fiat currency in late 2009, and then that famous first real-world purchase in May 2010, 10,000 bitcoins for 2 pizzas. Hard to imagine now.
Definitely. And today, Ammous notes while people do use it for transactions, its primary role seems to be emerging as a store of value.
Which ties into another point he makes, what he calls the blockchain myth. He's quite critical of the idea that you can just take blockchain technology and apply it successfully to anything and everything separate from Bitcoin. He argues blockchain-specific design is really tailored to solve the unique problems of creating decentralized digital money. Many other blockchain projects, he suggests, are kind of like cargo cult science, copying the form without understanding the function, often ending up inefficient or without real commercial need outside of Bitcoin's specific use case.
Okay, so bringing it all together then, what's the ultimate promise of Bitcoin according to the Bitcoin standard? You mentioned store of value.
That's the main focus, because its supply is absolutely fixed at 21 million coins, something no other money form has ever achieved. He argues it's an unprecedented way to store value, the most reliable method to store value long-term, free from the risk of inflation by central authorities. It can't be debased digitally.
He connects this to the idea that human time is the ultimate scarce resource, right? Citing Julian Simon.
Exactly. If our time and effort are what's truly limited, then we need a way to store the value generated by that time. Because Bitcoin has this absolute, unchangeable scarcity, Ammous argues it's potentially the best store of value humanity has ever invented, precisely because it protects the output of our limited time.
And beyond just storing value, there's this theme of individual sovereignty. How does Bitcoin enable that?
By being decentralized and permissionless, anyone with an internet connection can use it anywhere in the world without needing approval from a bank or government. Transactions can't easily be censored or confiscated, unlike money in a traditional bank account. This empowers individuals, he argues, giving them financial autonomy, a way to opt out of the traditional system and protect themselves from things like government inflation or capital controls.
The book sums it up quite idealistically. Bitcoin, being completely voluntary and relentlessly peaceful, offers us the monetary infrastructure for a world built purely on voluntary cooperation. It's a powerful vision.
So reflecting on this whole deep dive, we've really covered a lot of ground. From why we even need money, the problems with barter, through the history lessons of primitive monies like race stones, the rise of gold, then the shift to government fiat currencies and all the consequences Ammous outlines.
And finally, landing on Bitcoin as this proposed digital solution, aiming to embody those principles of sound money, hardness, scarcity, decentralization. The key takeaways seem to revolve around that stock-to-flow ratio, the importance of money holding value over time, and how decentralization might protect that value and foster economic stability, maybe even individual freedom.
Yeah, and it leaves you with a pretty provocative thought, doesn't it? If Bitcoin's design truly hard codes scarcity and decentralization, how does that change things? It's not just about challenging monetary systems. It challenges the very nature of economic power. What happens to that balance between individuals and institutions when money itself isn't just a tool controlled by governments, but potentially becomes a protocol anyone can use? That's something to really chew on.